Hi, this is Randy Finney with Right Side of the Chart, and today is Monday, April 3rd, 2017. Hope everybody had a great weekend. I wanted to do a quick market wrap up, and I was going to talk on the broad markets. Now, there wasn't a lot to report. That's why I only had one front page post today on the site. I pointed out, highlighted a breakdown in the biotechs. And on that same line, I want to go over just a few key sectors that I'm watching right now. I'll cover the biotechs that I mentioned just briefly. It's not a whole lot. I'd like to see a little more follow through to the breakdown today. It happened relatively late in the day. But I wanted to highlight a few sectors that stand out to me right now. Time permitting, I'll touch on the broad markets again at the end of the video, but not a whole lot has happened today. So let's dive into the sectors that stand out to me. Some of these are active trade ideas on the site, and some of these aren't active trade ideas, but I'm watching very closely. May pull the trigger. Might already have short exposure in some of those trades, but may add those as official trade ideas. And again, I think they're significant sectors in the overall stock market, and that's why I wanted to cover these as well. Starting here with the financials. Financials is an active short trade, XLF. And this one we're looking at a daily chart here. This chart pattern is very clear to me. This is almost straight out of the textbooks, a bearish rising wedge pattern. I'll draw it out here since I have quite a few lines. So the two purple lines that I just used show a very clear bearish rising wedge with clear confirm with negative divergence, which I like to see on the wedges to confirm the bearish nature and likely trend reversal. That was followed by an impulsive breakdown. That's additional confirmation there. Impulsive price action. You see all the red bars of selling, a lot of volume. And just recently, after such a pretty swift move down, near-term oversold conditions, we've set up into what appears to be a bear flag pattern. Actually, I could probably zoom in a little bit, and you guys can see that better on the video. So there it is. Again, I drew it out. The wedge, the breakdown, the formation of what may be a bearish pennant continuation pattern. Either way, if it doesn't fit the perfect mold of a bearish pennant, in concept or at least in principle, that the same effect is happening. We had a very impulsive move down. Prices get overstretched, very oversold on the near-term time frames. You hit support, not to mention that. There's support there on the daily chart. And so obviously you're going to get a reaction sooner or later, and that's what we had. And today looks like we broke down below and closed below that potential pennant pattern. Trend indicators, I use the PPO or the MACD above or below this zero line, indicating whether a trend is bullish or bearish. So that's bearish. And so by all accounts, this chart looks to me as if the financials have more downside. And if you break down from the bear flag pattern, I could draw it here. Let's just show you here. If we do break down, if it is a bearish pennant, I should say, I said flag, I meant pennant. The expected move would be the move down would mirror that of the flagpole, and that's just a measured target. So that could take us all the way down here or to my potential third target. There's also a gap to be backfilled right here. I should have a support line there, definitely a support line there. And that comes in around, say, I don't know, 2175 or so. And that would certainly be a potential target, and I should add that to my chart. I'll do that later. 60-minute chart, let's just look what happened in XLF. This is a well-defined trend line. I'll color this something that jumps out at us, bright yellow. Okay, XLF it's currently an official trade idea. I believe the short was on a back test to this level. The short entry was based on a break of that daily rising wedge, as well as this. I used this 60-minute chart to hone in on the price target. I had a support level here at 23.85, and as I always do, I set my buy to limit cover orders just above the actual support level in case prices reverse just shy of support, which they sometimes do. In this case, XLF went on down through there, but remember, support once broken becomes resistance. So this was a beautiful case of technical analysis, at its finest here. You can see prices rallied back almost to the penny, failed. So there's one failure at that level. Rallied back again, failed. Now, this may be a glass half empty, glass half full case. I can see this. If you're bullish, you might say, oh, well, I see an inverse head and shoulders pattern. First of all, I don't give inverse head and shoulders patterns a lot of credence on the intraday time frames. Some traders do. Maybe, and sometimes they work out, but for the most part, Um, I don't see volume confirming this pattern either way. Something to watch. Maybe this is now a second right shoulder on the inverse head and shoulders. So it looks something like this. Head down here, shoulder one, shoulder two. So I want to point that out, but we have an upsloping neckline, so it's got a lot of work to do if it breaks that out, since we already took out that level. Now, what I see, which is the glass half empty, as you guys know, or it wouldn't be short XLF, I see multiple failures, two failures, almost perfectly at a key resistance level, former support. Then on the third attempt, we took it out, but on a feeble attempt. There was not the volume was not confirming that breakout. The breakout failed, and as I often say, fewer things in trading are more bearish than a failed breakout. So after that failed breakout, we had a very impulsive move back down. So 3 strikes when you're out, I view that as a pretty feeble attempt, or a failed attempt, I should say. Valiant effort, 3 attempts to get back above there, but on the third one, we moved down impulsively. So this is a near-term battleground, a level to watch. Just, I want to look for a solid or impulsive 60-minute break and or close above that level. And if not, like with everything in the broad markets, I'm looking for the next break of these previous reaction lows right here. That would be the next sell signal. In fact, in XLF, I could probably draw some support level. If I look at that reaction low right there, yeah, it looks like it lines up quite well with a few reaction lows here. So there's your next sell signal, if you will, in XLF, just above the $23 level. One other thing to point out on the financials. You guys know this, that fewer sectors, if any, exploded like the financials after the elections. They call it the Trump pump. And, there was really 2 main components went in there. The talks of a partial or full repeal of Dodd-Frank and decreased regulation in the financial sector, as well as the fact we'd probably see interest rates continue to rise. For those of you not familiar, the way that banks make money, other than their trading desk, gaming the markets, using insane leverage, in profiting from their trading desks, the old-fashioned way, and the way that a good part of banks' revenues to this day continues to be what they call the spreads. In other words, banks, they take in money, your money, my money, they take in deposits in the form of checking accounts, money markets, savings, CDs. Those are short-term instruments, mostly liquid. And then they turn around and they lend that money out to other consumers or businesses in the forms of loans. That would be a car loan, 5 or 7 years, let's say on average. Home mortgages, 15 to 30 years. Home equity lines of credit. So again, it's very simple. Banks take money in. They pay you a low rate of interest on short-term deposits. They turn around and charge a higher rate of interest on those longer-term loans. Now, and the difference there is called the spread. So let's say on average right now, if they're paying out, 0.3 or 0.5%, I don't know what the average deposit rate is. Of course, you get a higher rate in a CD or a money market than you do in a checking or savings. But so if they're lending money, let's just say at 0.5%, or they're paying you on the deposits, and their average rate between mortgages, car loans, business loans, everything is 4%. Then there's your 3.5% spread. And what they like to see is long-term rates increase, and short-term rates have very low short-term rates. And that was the expectation here. There was all this talk of the Fed raising rates, finally backing off, which they have. However, let's look at what's really happened, and this is where you have your biggest opportunities in the market, when something is priced in and fully expected, and the opposite occurs. This is a treasury yield curve. If you're a gold member of the site, you can access this under the useful links category. You just go to resources on the top menu of the page and then click on useful links. You'll see it under there, a link to the U.S. Treasury yield curve. And so for those of you not familiar with what we're looking at here, these are just the rates on treasury bonds, notes, and bills. So you have your 1-month T-bills, 3-month, your short-term treasuries right here. This is the rate on this side. the percent. So you're looking at long-term 30-year bonds. Go down to the bottom. The 30-year bonds are at about 3%, and your 1-month and 3-month T-bills and even your 6-month T-bills are all under 1% right now. So where am I going with this? What I did is I compared two dates. I took the first trading day of the year, January 3rd, 2017, and I compared it to today. So here's what we're looking at. This green line right here is the current U.S. Treasury yield curve. And you can see there's an inflection point right here where it crosses over. So in other words, since the beginning of the year, which is this blue or purple line right here, that's as of January 3rd, 2017, this is what interest rates have done. Short-term rates have actually jumped up considerably. And you can see, as we know, because the Fed's been hiking rates. However, unlike market expectations or what would be favorable for the banks, long-term rates haven't hardly budged. In fact, more accurately, long-term rates have dropped down. You can see here that it inflects right here about this point. So really anything after 2 years, what's happened is longer-term rates have fallen. So what this means is the market's not buying into what the Fed's selling. The Fed is just jawboning the hell out of rates, trying to talk the long end of the yield curve up. And I've always said this, the Fed has absolutely no control over long-term rates. They don't set the long-term rates. Those rates are set by auction. Even then, they're set on, at auction and the secondary market, these bonds trade. The Fed can't control. They can try to buy a lot of these bonds. They can try to manipulate the market. But what they can set are the short-term interest rates. They set the federal funds rate and the discount window, money which banks must borrow from the Fed or each other. That they control, and that is you can see as the Fed intended backing up, but this is exactly the opposite of what the banks want to see. This is not profitable for the banks if this continues. So short-term rates have backed up. What that means is banks are now paying us more on our deposit rates. They're paying their deposit customers more, but yet they're not collecting any more on the long-term loans. They're not issuing new loans at higher rates right now because anything out to the 2-year mark, as you can see here, has not only not increased, has actually fallen when you go past. That's the inflection point. So this isn't good. And if you see this trend continue, either you don't necessarily have to see long-term rates fall, but if they're not budging and you see short-term rates continue to back up, that's what they call a flattening yield curve. It's also indicative of a recession. When you see a healthy yield curve is usually upward sloping like this. Something, if I had a parabola tool, I'd draw one. But this is not good for the economy. It signals bad things to come, and it's certainly not good for the banks to see short-term rates if that trend continues to rise while long-term rates either don't rise or do fall or even sit still. So just a point to a couple fundamental things that I wanted to drive home and why I'm still pressing the short case on the financials, why I think there's more downside to come. All right, let's get back to the charts. And what I think I'll do here is I'll cover the other sectors in another video. I spent a lot of time talking on XLF, and I wanted to look at a few of the banks. Since this is an active trade, if you're in it, you probably have an interest in these charts. So I'll wrap this video up after I just cover the charts here real quickly. A few of the big banks. Here's J.P. Morgan, J.P. Morgan Chase. As you guys know, one of the biggest banks out there. And same story. You can see the bearish rising wedge pattern, the breakdown, a little bit of a back test, brief back test, and a very impulsive selling. And what appears to be, if you look at it here, appears to be flagging action. If nothing else, that's just consolidation. Before the next wave down, more than likely, and I see that move coming down to, at very least, you can see this horizontal line I have here. I think that's a minimum target on JP Morgan. It also comes in well. I don't know if you can see it there. I have a potential uptrend line drawn. So that would be, even though that would measure shy of the bear flag projected target, because there's your flagpole, that would probably take us a little lower. And maybe we do briefly overshoot that level. But either way, to try to quantify it for you guys, get that line out of the way so I can use my measuring tool. Grab, I'd say about another, yeah, about another 5 to 6% downside in JP Morgan. And if JP Morgan drops 5 or 6, I will all but guarantee you XLF is going to go down close to that number. All right, a couple more. Citigroup. There it is, very well-defined uptrend line. 1, 2, 3, 4, 5, several reactions there. Breakdown, back test. This one's just getting going. Rising wedge, you can see the divergence here at the highs. Negative divergence confirmed. Minimum target right here, that's at 55, 57 is where I have that number. So give or take a few pennies, call it 55, 60 if you wanted to cover there. And if things get ugly and that level breaks, we may run all the way down here to 50, 22. So, as of now, I'm looking for a move down to at least that, and what was that, 56, a little shy of 56 level. And if that breaks, we may be heading all the way down here to that almost $50 level before a meaningful reaction. Probably get a little blip right here because that is support. And we'll just have to take the charts as they come and then decide whether we cover XLF when all the banks hit these near-term supports. And that depends on what kind of trader you are. If you want to take the quick buck and take profits, maybe jump back in when support breaks. But I really think that the conditions for a waterfall sell-off in the coming weeks are pretty ripe right now. We haven't seen that yet, but it's possible. All right, let's look at a couple more. WFC. And by waterfall sell-off, just so you guys know what I mean, just jump back to that. Waterfall sell-offs mean they tend to just smash through support levels like they're not even there. They might produce a very fleeting reaction. Here's Wells Fargo. Again, just the pattern on all these are very similar. Rising wedges, clean bearish rising wedges with steep, powerful negative divergence. I mean, XLF was one of the best shorts I've seen in a long time. And that's why it went on as two official trades lately, the active one and the previous one that we already closed out for a profit. There's your flagpole. That's a pretty big flagpole right there. Here's your bear flag. Flag or pennant, however you want to draw it. That's probably more of a pennant. They're 6 to 1/2 dozen. They take a slightly form, but the same thing. You take the flagpole, you add it to the lowest point of the flag or the pennant, and then you add that flagpole to the top of the pennant before it breaks down. And I think this one's going down here. I have that red line about 51.85. But again, there is support right here, pretty decent support at this line here. That's around 53.50 or so. So maybe a reaction there. We need to watch that level. A waterfall sell-off could take us right through there. Otherwise, look for a reaction. And if you're a swing trader and you are pretty bearish on the financials, you might want to tuck it away and hold on to a move down to that 52 level. Again, that's Wells Fargo. I'm not putting the individual banks as official trade ideas now, but by all means, if you like the charts, I don't see why and you have enough to spread it around and take individual stocks versus the ETF. I always say I think you can do better shorting individual stocks versus trading the ETFs. Because the ETFs are going to own both the most bullish and bearish of all the stocks within that sector, whereas you can selectively short or go long the most bearish or bullish stocks within an ETF or a sector if you have enough to diversify properly and the time to manage all those positions. So here's Bank of America. This looks like a little bit different on this one. This is an ascending broadening wedge pattern. I didn't draw it clear there with that line. The white line shows it. A breakdown and a back test, and we're sort of consolidating or flagging there as well. Key support not too far below, so maybe not a little hiccup reaction, but a lot of thin air under this one. If that support level around 22 gives way, I don't see decent support to this gap right here. There's a gap to be backfilled there at 19.5 or so. You can check that on your chart. And so this one could fall all the way down there, maybe backfill the gap and continue on down here to all the way to 18 or so. Again, it's all priced in the charts. I could easily see that scenario playing out. We'll need the broad market to cooperate. I can tell you this right now. The financials aren't going down another, what is that in percentage terms? They're not dropping 25% without the broad market having a pretty healthy correction. So again, a lot of these trades are all predicated on what the broad market does. A couple more and we'll wrap up this video. Financial. Here's Visa. Visa, obviously, you guys know, is a credit card company. It's big divergent high. I didn't have it drawn out here. I'll take this old divergent high, which did play out for a correction. I'll use that line right here. Slide it forward, and you can see extremely overbought. about flat line divergence, about equal highs there, but yet prices made a much higher high. So I'm going to take this line here, if I can grab it, yeah, put it up there and highlight that divergence. There's the negative divergence in play. This is a price channel. Visa is flirting with the bottom of that price channel now. If it breaks that price channel, I'd have to really haven't had time to mock up all these charts, but there it is. This is a what I call a high probability target. 83, 82, maybe a little bit above that. That's the bottom of a gap, number one. Well, at least this reaction before a gap. That gap started down here. But you have a lot of reactions right here, quite a few reactions. You also have the gap. So my expectation at minimum is for when we get a breakdown. Now, we haven't broken down yet. We had an intraday break today. Here, let me zoom in for you. See this doji that was put in? That means prices broke down during the trading session, but managed to close right back up below or above the trend line. So we need to see that one go with conviction. In fact, I can tighten this trend line up as I zoom in here. Let's clean it up a little bit there. That's a better trend line right now. It has a little bit better fit. Sometimes I just rough sketch these charts until I get ready to pull a trade and pull the trigger on a trade. Either way, it's a trend line to watch right there. And if that goes, I think that gap, we could have a reaction off the top of the gap about 84.92, but I think that gap's going to be filled, not all the way back filled again. The bottom of the gap is over here. This is where the reactions are. That's the level I'm looking at, 83.82. And birds of a feather flock together. So if Visa goes, I doubt Mastercard will be far behind. And this is MA, Mastercard. This is a trend line here. I believe I have an alert set on it. If I don't, I will set one now. And that's basically, now not everything's drawn out on these charts. There's divergence going all the way back for quite a while. Negative divergence. Big bearish rising wedge, and if you want to know where I think that one's going, I would say, I'll have to look at this chart. That one's a little tough, but I would say this would be the first target there, about 103.16. All right, let's wrap it up here, and I'll do the other sectors within different videos, either later this evening or get those out tomorrow. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.